All right, then. So tonight we're going to talk about taxes. Taxes are huge, hugely important. Something that, believe it or not, you have a lot of input into the whole situation. Some people just blindly pay their taxes, and the government's happy with that. In fact, most people overpay their taxes. To tell you the truth, they're frightfully scared of the IRS. I've dealt with the IRS on a few occasions, and actually, it's gone all right. And it's a long story, but a couple stories actually. But I don't want to go into too much with it. But yeah, I prevailed, and everything's fine. And I'm not like at some club fed, and I didn't have to give up a whole bunch of other stuff. But I did, pay the basically the minimum amount of tax that was due, which sometimes calls scrutiny. Also, I've got foreign property. I've got businesses that dealt with cash and just a lot of red flags in terms of the IRS. So go figure. Plus, I hired this lady who she was better than me at taxes, really good, like too good. And yeah, that's because she bent the rules, but they understood and whatever. It all worked out in the end. So lots of stuff going on. Let me see where we're at. Oh, look at that. Oh man. Okay, so yeah, these guys are kind of consuming all my time right now. There's just four of them, but yeah, they're pretty cute. This is out at the beach. They're out running around, so they're fun enough now where they can play with the other dogs and all. But thankfully, I ran them hard, so hopefully they're sleeping for a little while. Moving on. So anyway, background on taxes. Yep, it funds everything we do. It's they're a necessary evil, I guess. And they're taxed on. In my mind, you're taxed on pretty much everything. You can call it a use fee or like a DMV fee or in my mind, all that stuff is a tax is a tax, and taxes are used kind of manipulatively. They try to encourage certain behavior they want and discourage other behavior they don't want. In addition to taking in some money, so you pay it on income. That's where the bulk of the money comes. We'll show some charts on that. Purchases, if there's sales taxes involved, wealth transfers. That's really, it depends on the administration, depends on where you live, obviously, but inheritance taxes and stuff are a thing, and then assets and things like that, stocks and stuff. Now it can be argued that the rates on things like that, like stock market gains and real estate gains and stuff like that, are taxed at a lower rate, but essentially, unless you're, some nepo baby or something, unless you got the money from someplace else, if you earn income, you save it, you invest it. Well, when you initially earned it, you got taxed on it once, and now you invested it, and when you draw it out of there, conceivably you're getting taxed on it twice. That's not, it's an argument people make. It's more compelling in the corporate world where they're pay taxes to individuals, and then the corporation is taxed as well. So that's a more of a clear cut double taxation. And then these things are called sin taxes. Not that gasoline's a sin, but cigarettes and alcohol, yeah, they're exorbitant. They can make those things whatever because the constituent base, whatever, not a high percentage. So how are they going to defend themselves when it comes to being voted against it? Yeah, there's a lot more people who'd like to punish them than there are people who, smoke, for example. And especially if you can say it's society. And I'm not an advocate of cigarettes. But again, if you want to manipulate that behavior, it's one way to do it. And then gasoline. Now, some of these taxes, and I would argue all three of these certainly fit in this category, those would be considered regressive taxes. Progressive taxes are what we try to portray our tax system as. Progressive means that or the wealthy person can pay more in the way of taxes, and the person that's just scraping by or poor, they ought to be able to get a little bit of a break. That's a progressive tax. But these ones, alcohol, where it's just a set rate regardless of your income, that's kind of considered regressive. For example, let's say, I would even throw, maybe this is a little controversial, but speeding tickets and traffic violations into a tax thing, or at least the way they're done locally in my mind, where there's quite a few. I go between the Valley and Anchorage and whatever. There's definitely some revenue collection going on out there on the roadway, and so if somebody's a millionaire and they get hit with $100 speeding ticket, yeah, that's gonna piss them off, maybe leave a mark. But if you're some minimum wage guy and you get hit with $100 speeding ticket, that's gonna ruin your entire week. And so, if a millionaire again goes to buy some alcohol, a percentage of tax that's figured into that, and there's more than just local sales tax. There's, the alcohol, tobacco, firearms, the stamps. If you ever look at an alcohol bottle or even beer and stuff, there's taxes that are already built in addition to sales taxes. And then cigarettes are pretty upfront. Such a high component of that is tax. So, we'll talk more about that as we go. Corporations pay taxes on profits. So, yeah, that's where I get into the double taxations. Because corporations are owned by people, right? People pay taxes, and then they own corporations. They own stock, and they pay tax on that again. Property tax, we're aware of that. What are they used for? Government's programs, services. Some good, some, maybe not so efficient, but whatever. That's a different subject. Most individuals pay taxes at federal, state, and local levels. So obviously we get a pretty good break here in Alaska with, the permanent fund. The permanent fund, it's not directly tied to oil. It was funded by oil, but, people think, oh, the price of gas is going up or something. That's going to affect the permanent. The permanent fund, it's more run like a mutual fund where they were invested in a number of things. They used to have a lot of commercial real estate, which was kind of scary because commercial real estate, especially, during the COVID era and post-COVID, is kind of taking a hit. But they still seem to be cranking it out. They've got an investment board that manages the investment. Local levels, yeah, property tax, sales tax, fuel taxes go directly to them. And then the federal, which we're aware of, the federal income tax. IRS, yep. Time of transaction, so like a sales tax, withholding tax, and estimated quarterly payments. If you owe money, typically, they see that as a loan. The IRS sees if they give you, if you owe them a bunch of money at the end of the year, you'll probably get a little nasty thing, a penalty, and maybe they'll force you to do quarterly payments. People who get every year a huge refund, and they think they're getting one over on the system. No, they're just a useful idiot. What they're doing is they're doing just the opposite. If you underpay your taxes, yeah, the IRS is going to give you a penalty and they're going to force you to do quarterly payments. If you overpay your taxes, yeah, even the IRS, as inefficient as they are, they realize that this person's a knucklehead and they're going to give us a free loan. They're going to give us all this money to use and then thank us for giving them their money back at the end of the year. You control the amount of money that's withheld. Now, if it's a one-off, some special deal, maybe you had a child, maybe you did something with the house or something that had positive tax benefits. But if you're consistently getting a refund, yeah, you're not. That's not a sign of intelligence. That's a sign of you not knowing the system. So, yep, taxes close at the end of the year. So that's something you need to keep in mind. Like, let's say you wait till April 15th, the due date, and you say, oh man, I screwed up. I needed to, do something differently. And that no, it's closed. It closed out the end of that year. So it pays during the current tax year. So for example, if I want to do something that's going to affect my 2025 taxes, I need to do it in the 2025 calendar year. I can't wait till I go to prepare my tax and say, oh man, I should have sold some stock because now I'm going to get killed on this, or I had a loss. I should have, whatever. There's things to do. I should have donated some stuff. It's fixed. Or, conversely, well, not conversely, same thing, marriage or filings. You can change your filing status, but obviously you can't change your marriage. But well, you can. And right now, there's not so much a benefit to being single or married. It depends on the year, and it depends on your individual circumstances. But at a certain point, I remember, this was a long time ago, people would get divorced at the end of the year because it was a better deal tax-wise. And so they could, legally get divorced and then get remarried the next day or whatever and talk to your accountant or whatever. But within the rules, they could claim that they were, single or married for that entire year. Typically, taxes are better when you're married because you can claim that status. But we'll talk more about it. Everything about taxes kind of depends on your individual situation, which is a good thing and a bad thing. What I'll show you are ways to kind of calculate your taxes and do sort of a preliminary tax, run on your taxes using something like TurboTax or something like that before the tax year has completed. And oh, by the way, don't pay for TurboTax unless you're actually going to use it. But you can run through, you can do all the calculations, let it do all the calculations for you, and then just simply not file with them. You can do them yourself. You can have your CPA do them or your tax lady or tax dude do them. But you can run through on TurboTax and do all the calculations and just, you don't pay on TurboTax till you actually file. So I use it in this class all the time just to kind of show different examples. And I haven't given a dime to TurboTax for the account that I use in this class. Social Security, Medicare taxes. Again, a bit controversial. The fact that what happened to this money, Social Security is, boomers have this illusion that, it's in a lockbox. And there's some, I've been giving them all this money for my Social Security and it's sitting there somewhere. They've kind of raided that piggy bank a number of times. And anyway, it's insolvent. So there's things to say that Social Security may be pared back. It may be means tested, meaning they may look at your income, which is not quite right because it was originally conceived as a savings plan where you're giving them, the government, your money for safekeeping, and now before they give it back to you, they're gonna whatever. It's the situation is kind of in a bit of crisis. And then Medicare. Medicare is for when you're over 65, medical insurance. So anyway, we know about FICA, federal insurance contribution, Social Security, Medicare, and then earned income taxes. So anyway, all these things, you just see all the deductions on your check. And again, in my mind, they're all just taxes, especially if there's not a direct connection where you're going to automatically get it back. These numbers are getting kind of dated, but they haven't, whatever this is. It's a percentage. It used to be 6.2. I think it's up to 120-some thousand now. Withheld from your income. So if you have a couple different jobs and say you're lucky enough to have a couple that are making, say you're making $200,000 all in, you need to, basically get a refund back for the Social Security because you're only supposed to have that 6.2% taken out of the first $118,000. If you have two different employers or some side hustle or something that's being charged Social Security, you're likely overpaying. And then self-employed people, they have to pay it as well. Personal income taxes. So there's all these different forms, and my, this book is kind of dated in this section. in terms of some of the forms and stuff. Most of it's done electronically, which is a good thing because keeps your data. And there's no reason to get so enamored with the forms. Where you want to spend your time and your brain bites on this is on how to pay the least amount of taxes and not how to fill out the stupid forms. Plus, if they're easy to do on a computer, you can run different versions. You can file single and see how that works out, or you can file jointly. If you're married, and then head of household. There's different filing statuses, and just what if I give to charity? How's that affect things? What if I buy a home versus rent? How are all these things going to work out? Rather than just filling out forms. And federal deadline, as we said, April 15th. Kind of a fuzzy slide, but this is where the government gets the tax. So you can see that over 50% about is income tax. A little bit of corporate tax in there. Payroll tax is a big chunk. So that's the other taxes in addition to just your tax, and then excise taxes, those, and then other taxes. So apologize, I need to fix that slide. This is what I'm talking about with the progressive nature of the system. So they have different tax brackets, and we'll talk more about that as we get into that section. But yeah, the bottom 20% of folks in terms of income are actually not paying taxes. They're getting money back. So there's different credits and different things they can get to kind of give them a break. The next 20%, they're still not paying much tax, or it's almost neutral, about 1%. The middle, they're only paying 4%. So you can see that we got 6% basically, and this is the middle class, 13 up to 88% up there. So, so when the rich, they do kind of get taxed at a higher rate. Now, there's a guy, I don't know if I have it in here, but Laffer, the Laffer curve. Basically what he talks about, and again, some people, well, it's not really arguable. His concept is that if you set the tax rate too high, you will actually reduce the amount of taxes that is provided to the government. So if you look, big picture, where some politician will come out and say, "Oh, we're going to tax all the millionaires at 90%." I think the French are doing this right now. It's a joke. They won't tax the millionaires at 90%. The good thing about being a millionaire is you can friggin' move, and they do, and they don't pay that tax. It sounds good in the election, but in reality, they never collect it. Now, if they say we're going to tax the millionaires at 10%, well, that's not going to generate that much money. So in between those two extremes is a certain amount that will be considered roughly fair, not, get these folks moving out of the country to avoid the taxes. In fact, it will, the reason those people are millionaires is most of them are not idle rich. Most of them are investing. And if you say that set the tax rate at 25%, well, maybe you'll motivate them to expand their businesses, which is good for everybody. If you up it to 40%, now they're like, I'm gonna cut back. I for every dollar I make, I'm only getting to keep a smaller percentage. Now, conversely, again, if you set it at 15%, they may say, I'm not whatever. 15% is the rate for long-term capital gains, and that for most people is not considered a huge burden. In fact, that encourages investment. So that's why long-term investments are taxed at 15%, and that, for long-term rates, is probably around the best rate because it doesn't demotivate the investors who expand the businesses, and yet it's still, a substantial enough amount to provide income to the government. So it's all super complex, and I'll go through it. But the reason why it's all complex is, well, there's a couple things. Is one, there's industries that have been built up around this. This whole Intuit is one of the big companies. They make TurboTax. They have all these different tax programs. There's fleets, and there's a whole industry that help people prepare their taxes. And then there's all sorts of lobbyists who have whittled out certain tax deductions for their particular sector, their particular industry, and they're not willing to let that go. It would be so much easier if we just had a flat tax and we're just done with it, and we didn't waste all this time preparing taxes. But politically, that's kind of a dead in the water, because who's going to support it? Not the lobbyists who influence the politicians and then also can, lobby you during election times. So we're kind of stuck with it. It's funny, I've lived in other countries, and I wasn't forced to pay the I have to pay property taxes in Germany, and I had to pay them in Spain, but I was never taxed on my income in either of those countries. But especially like France is always the example they use. The French, if you try to charge them income tax, well, I think the Germans as well, they're sticklers for rules, but not that one. I don't know that they would pay their income tax. And so, they don't want their version of the IRS. They don't want this huge bureaucracy that's basically a collection agency. They just make their sales tax, they call it a value-added tax, and it's a value-added tax on every transaction. So every time a thing changes hands in the supply chain, this 20% tax is applied. Now, you can imagine if we had a 20% sales tax, that would, change things a lot. But they don't have an income tax. They are very little. It's most of their tax generation is done through these value-added taxes, which is kind of simple. And the other thing that's devious about the way Europe does it is it's not stated on the price. You go into, buy some groceries or something, and you go up to the register, the price you pay is the price that's marked on there. The taxes are included, but that's done by the store, by the vendor. Here in the States, they add the tax after the fact, so it reinforces, oh my God, look at the amount of tax I'm paying. In Europe, you think, oh man, this is great, there's no taxes at all. Oh no, those taxes are in there, and they're included. So just a different way of doing it. This is something that's kind of interesting that, again, I'm trying to, big picture wise, show you why, wages, for example, or taxes, how they haven't really kept pace with, with the stock market specifically. But this is the rise of minimum wage and where it would be if it had kept up at this rate. So right now, this was, again, a bit dated information, but probably a more useful slide. Let's look at this. Median income versus the S&P 500. So you see, at first when I was looking at this chart, I'm like, wait a minute, they don't have the correct line here. Oh yeah, that little distinction there, that little bit of growth, that is the growth in median income from 74 to 2023. So to say that's flat is not really an exaggeration. look at the S&P 500. So the S&P 500 is up 4,000%. Your wages, yeah, not so much. And that's why I'm, kind of arguing to get your money invested, get your money where it can work for you. So, also, when you make money in the stock market, it's taxed at 15% if you've kept it over a year. If it comes in as personal income, it's taxed at a higher rate. Sometimes around, well, we'll look into tax brackets. That's a greatly misunderstood concept, but let's say an average tax rate of around 28%. That's going to change, based on politics and stuff. The long-term capital gains rate at 15%, that's been pretty constant for a while. There are calls to increase that, but it's much more likely that the income taxes in general will be taxed at a higher rate, not the capital gains tax. So, okay. So that's enough about the theory kind of stuff. Let's look at the actual mechanics, the things you have control over. So, filing status. Single is a category, you know if you're single or not. But from an IRS perspective, this is going to be the, percentage-wise, you're going to be paying the highest taxes in that category. If you're married, you have different options, and this is where you might want to run your taxes a couple different ways. If you do it married filing jointly, you're going to come up with one amount for the two of you. And married filing separately, you file individually, but you still check that block. And so, depending on the tax code, depending on your incomes, your situation, you're going to get different numbers. And so that's why I can't say, oh, you want to file individually or you want to file jointly. It depends on your income. Sometimes, if one person is making a tremendous amount of money and the other person is not, you might want to file separately, because that person who's filing individually or separately and with that lower income might be down in that lower rung where they're going to be paying less tax or perhaps even getting some tax back. And the person who's knocking it out of the park, you may not want to be associated with them when it comes to paying the income taxes. But anyway, you have to look at it. Head of household, like I said, the preferred category between being single or married when it comes to taxes to be in the married category. But let's say you're somebody who's quite common, the single parent, and or you have an elder dependent, something like that. You have to check the tax code. But if you have dependents, then you can claim head of household, which essentially puts you into the married category for filing purposes. Now, if you're, a couple that's split up, you can't both claim, the same child. A dependent can only be claimed by one person. So, qualifying widower, so, you're having a bad year, bad day, and, your spouse passes, and, according to the IRS rules, they're not going to, throw you under the bus. They'll, throw you a bone. They'll give you a certain break on your taxes for a certain period based on your situation. And so, it wouldn't be fair to say, oh, you're single, so here, pay your taxes. You at least be able to claim head of household, but there may be other status. So that's always a block on the forms. These are how the forms work. Now, all this stuff up here, this is all your address, your social security number, all that. If you're doing it on a computer, this is all could be pre-populated, because it's there from the year before. Or, with, TurboTax and these other programs, They can draw it off one of your pay stubs or something. They can draw it off your mortgage, or your brokerage or whatever. A lot of this information that is just kind of busy work on your part, mindlessly typing this stuff in, it can already populate that, and it knows how many kids you have in the year before and their ages and all that kind of stuff, and it'll say, hey, are there any changes? And if you say no, boom, you're on page 2. So getting wrapped up with all these forms and doing this stuff by hand is not something I haven't done in, I don't know, 15 years. I've run my taxes a lot, and most of the time I file them myself. But I've been in some interesting situations where I had my own subchapter S, and I had some other stuff. So in order to steer clear of any new friends in the IRS, I've had a CPA do it, and if a CPA puts his name on it, her name on it, you have less involvement with the IRS folks. They're looking for an easy kill. Gross income. So on gross income, this is the amount of all this income from, interest, dividends, capital gains, everything that came in. So the deal with this is there's going to be different rates for, say, long-term capital gains, but that's going to change. We'll go more into that later. Interest income, yep, that's going to be added to your income. Your PFD is going to be in there. If you're getting alimony, not child support. If you're in that situation and the judge wants to give you alimony or child support, you definitely want it lumped into child support if you can, because alimony is taxable. Child support obviously is not. Dividend income, yep. So that's going to be paid in the current year. Capital gains. So this is that short versus long. So this is what I was saying for anything in personal finance and IRS rules. Short term means less than a year. Long term means more than a year. So if you're, making a lot of money in the market, and you're like, wow, that stock's pretty volatile, I want to get out, that's probably a good thing. But if it's not so volatile, or you're confident, you're at 11 months and you don't think it's going to dip anytime soon, if you can, hang out and get it where you've held the stock for over a year, then your tax rate's going to be 15%. If you take it quickly, it's going to be, taxed at your normal tax rate. It's going to be added to your earned income, basically. So, it depends on your tax bracket, between 0 and 20%. I'm typically, it's 15% for most of us. Determining gross income. So any source. If you say you go to Las Vegas and you win a chunk of money, or even the big lottery, you can tell if you've got a pretty good sized jackpot when they come walking out and they hand you tax forms. That's because, they want a part of that. I think it's a 1099-G. But anyway, any of those income type things, and they've gotten, as automation has picked up, their ability to figure all this stuff out and add it to your tax transcript, that is a thing. This is something I didn't realize till a couple of years ago, but you can actually access your tax transcript if you want to. It's kind of cool. You can go on the IRS site and you type in your data and establish a password and all, and it'll basically show what the IRS shows for that current tax year. So if you're doing your taxes yourself, you probably want to go there and check it out, because if you happen to miss some source of income, and the IRS has it, and they go, wait a minute, he didn't report any tax on this one, they're going to call you on it. And so better for you to find it first and make sure you file all your documents that they have records for. 1040, So, we got different versions of the 1040. If your taxes are super easy and you're not, very, you don't have much going on in your financial life, yeah, it's quite easy to do your taxes, but that's not such a good thing. You want to have more complex taxes. You want to have, write-offs. You want to have mortgage interest deductions. You want to be, deducting your charitable things. But here on the Schedule B 1040, they're still looking at the income. The funny thing is with all the foreign stuff, I don't have to deal with that too much because I have to report the rental income on the property. But since I have less than $10,000, which by design, if I ever see a balance on a foreign account getting up to $10,000, I'll do something because I know $10,000 is the limit before you have to start making it more complex in your tax situations. Capital gains and losses. So again, they're talking about short term and long term. You definitely don't want, well, capital gains are great regardless of where you get them, but yeah, you prefer to have long assets held more than 1 year as opposed to short term held less than a year. Anyway, you're going to come up with this amount, and they're going to say, okay, you owe this much in the way of taxes. And there's no magic to it. The tax calculations are done each year. They come out with a new chart and table, and you plug your income in there, and it tells you what you owe. So the AGI, so we had gross income, and then AGI is here IRAs, alimony payments, interest paid on student loans, other special circumstances, things that may change from take down your gross income. It's going to reduce it a bit. Standard deduction. So what happens is the IRS, this is a good thing. They're, realize people are going to have deductions. Like, let's say, back when I was in the military, people would, I have to keep my hair short because of, military standards. It's an unreimbursed expense, right? If a company's paying you for something, you can't, again, claim it as an expense because you've already been paid for it. So anyway, some sort of unreimbursed expense. And especially like if you're as a professor, for example, if I want to buy a bunch of books, I can consider those a business expense. If the university didn't pay for them and I had to pay for them out of pocket, those would be a business expense. I could deduct it. And then in the big ones, though, would be things like home mortgages, home mortgage interest, the taxes paid, property taxes. Those are deductible as well. So there's some big deductions that you should be taking. And let's say you come up with, $15,000 worth of deductions. Well, the first thing you do before you claim that deduction is you compare it against the standard deduction. And the standard deduction is probably like 18 grand. You go, well, yeah, I had some deductions, but I didn't meet the threshold. I'm better off taking the standard deduction. Now, if you've got, a mortgage and property taxes and you gave something away and all these other things, you probably want to do itemized deductions. You want to get credit for all your little expenses. You're going to say my itemized deductions exceed the standard deductions. They're the standard deduction, therefore I'll take it. So anyway, not affected by income, affected by status. They change it each year. So we'll look at it as we go. Again, I think it's about 18 grand now. So standard deduction, these ones are quite a bit lower. So you can see that, the numbers change based upon your filing status. Itemized deductions. This is where you go ahead and you make all these calculations. And I'm going to show you an example of this in a second to sort of show you the effect of these itemized deductions. So, yeah, interest expense primarily on mortgages. I think with the new change, I don't know if they've taken effect, but I think interest on, I think it's American-made vehicles may also be deductible. So this is a super controversial one, depending on the politics. Generally, blue states, Democrat states are, definitely in favor of SALT deductions. That's state and local tax. So, state and municipal taxes within a range. And red states and Republicans are not so much in favor of allowing for state and local tax deductions, or they want to put limits on it. So let's say you get a case like California, definitely a blue state, Democrat stronghold. They can raise their state income taxes. So let's say you're a pretty wealthy guy in California. Your total tax rate, it used to be 63. I think it's up as high as like 68% now. And the amount of tax you're paying between your state and your federal taxes, it's pretty darn high. So the reason why it kind of got that way and could be worse is because on the state level, there's not a lot of incentive to lower the state income taxes, because they charge a separate income tax on your state income, on your income that you make as a resident of, say, California. And they say, oh, don't worry about it. Even though that tax is high, you deduct that amount from your federal income tax. And other states, like, say, Alaska or red states, are like, wait a minute, that's not fair. Why does the federal government get less money? Because California allows, the federal government allows Californians to deduct their state tax from the amount they owe to the federal government. So, let's say you owe, 20 grand worth of tax, but you already had to pay 20 grand of federal tax. And let's say you already paid $5,000 to California. Well, if you allow a deduction for state and local taxes, the Californian would only have to pay $15,000 to the federal government. Now, if you're somebody up in Alaska who doesn't have, those kind of taxes, the state taxes, you would still pay all in 20 grand, but the state gets none of it, and the federal government gets the full 20,000. So it gets very political. Sometimes they just set limits on it where a certain amount is deductible, but there's some compromises. But anyway, that number can change. You can see taxes can get pretty complicated. Real estate taxes, yep. So that is normally tax deductible. Medical expenses, which is a good thing, but the bad thing is that it's 10%, and they're only unreimbursed expenses. So let's say, you have a $200,000 medical expense, but your insurance covered, 90% of it. Well, you may not even get any money back, because you look at that remaining portion, and if you're making 100 grand a year, you need unreimbursed medical expenses in excess of $10,000 before you can even start to itemize. So if you're out of pocket, say $15,000 worth of medical expenses, and you're making 100 grand, well, only $5,000 of that is eligible for, deduction. Charitable gifts, cash property, things like that, those are deductible. So, anyway, we'll look more at this stuff as we go. Other expenses, yep, I've done this before. I wrecked a car, I didn't have insurance on it. Well, I had liability only, but, It's only $3,000 or whatever, but I wrote it off as a total loss on my taxes. Fair enough. Summary of deductions. So anyway, you come up with those numbers after you do all your work on your deductions, and then you decide whether it's, advantageous to stick with a standard deduction or whether you want to itemize. Itemized deductions, that's the form for it. And then TurboTax. So let's go to TurboTax. It probably timed me out. I was logged on here just a little bit before to try and make it quicker for us. And here we go. So, yeah, this is just a bogus account. I established you can do the same thing yourself. You can use your real data or no data at all. Whatever. Just get the thing to go into it. Yeah, kind of not a huge fan of these people, but I'll use their stuff. So personal info, this is kind of cool because it's already pre-populated, bogus names in there, bogus dates. J Parks, not quite my name, close though. Anyway, and then you can plug in some numbers to see how things go. Now, the other thing that this would be carried over from year to year, which is nice. So, you're already off to actually doing your taxes, and you didn't have to fill in a bunch of extra queep that just kind of wasted your time. Okay, mortgage interest. I'm saying that this isn't too unlikely. $15,000 worth of mortgage interest. That's a fairly reasonable amount. You get a thing called a 1098 for a piece of property that you own, and it has those numbers on it. So this is the property taxes. Again, depends where you live, but in the borough, and the muni, that's probably a fair number. Depends on your thing. Here's donations to charity. We'll revise that and look at things. So I want to kind of show you a couple items here. First, let me go back to the wages and income. I put in here, okay, it's going to have me go through a whole bunch of things. Now, I'm just going to skip through all this. But you can see how this is maybe incrementally more pleasant than actually looking at the forms and trying to figure all this stuff out. You can dig down in and see the actual forms, but it's just sort of populating them as you go by doing this. Continue. Okay, so I said I made $100,000, flat $100,000, right? And I didn't have any investments I'm putting on here, so I just want to use this for illustration purposes. Okay, so it's saying since I paid a certain amount of taxes, I think I showed my withholding, didn't I? I don't want to go through all this again, but I have to. At some point on here, I pasted in a W-2. I think it was right here. Yeah, and I showed that some taxes were withheld. So out of that $100,000, I'm showing that my deductions, and I have some control over this by structuring my deductions, but I've already had $15,000 worth of income tax withheld. And it's telling me based on my $100,000 right now, yeah, I'd be getting a bit of a refund. Now, it's doing some math, though, by looking at some of the other documents that I've already filled out in terms of this deductions and credits. So this is kind of useful, though. You can go through and look at your situation and go, okay, what happens if I stay in a rental property? I stay in a nice condo, or I pay, another guy, my landlord, and he's going to be deducting the mortgage interest. He'll be doing it on an investment on a property situation. He won't be doing it on his personal taxes. But anyway, if you're just paying rent, and let's say your payment is about the same, what's going to change is this 15 grand goes away because you didn't pay it. So let's just edit that. Well, we're just going to delete it then. Fine. I'm just going to delete that 1098. Continue. Uh-oh. So you see what happened to my refund? It kind of got shot. Oh, what's happening here? Okay, yeah. Since I wasn't there, I didn't pay that property tax, so that's not tax deductible. Well, what's it want? Property taxes? No. Yep. This is where it gets a little frustrating, especially when you're trying to do it for a lecture. But anyway, my refund's going down because I did not pay those items. So, yeah, you can see the impact of being a property owner that just had. I mean, the muni, the borough, whoever is still going to get their property tax money, but because it wasn't paid by you directly, because you paid the landlord, who then deducted it on his taxes, he got credit for it with the IRS, but you did not, and so your taxes went up a bit. Now, I'm not going to say, oh, that's a no-brainer, go buy a house. No, there's a lot more to home ownership. There's a lot of other expenses involved, but there's also quality of life issues, and there's also the fact that you're owning an asset. And granted, that example I showed you was the S&P 500, but just the same, when wage growth is pretty much stagnant and other things are fairly stagnant, you want to be owning assets to the max extent possible. Okay, so we're getting back $1,100, which is, that's because we withheld that $15,000. So again, that $15,000 that I had withheld was essentially too much. I gave the government a loan. But let's say I'm a good person too. I'm going to give some money to not money, but I'm going to give them some products through Goodwill or whatever. This whole car thing, that kind of went away. You remember the old clunker thing where they donate your car to charity, and the IRS got ripped off on that too many times in their eyes. So now if you donate a car to charity, they don't give you nearly as much as the tax deduction. They make the charity that you gave the car to actually provide the price that car was sold at an auction, and it's not much. I had a beater with a heater, an old Jetta. That was cool, and I think that poor gentleman had passed away. But anyway, I paid like $800, and I'm sure somebody wrote it off on their taxes for $3 or $4 grand, $5, $6 grand, whatever. It was whatever. That loophole has been closed. So anyway, we'll help you. Yep, I'm going to say I'm going to donate some stuff. So let's call it, Goodwill. And I gave a whole bunch of junk. I may want to have some pictures, may want to specify. They even have these services now that, it's deductible. And those people, they get a little something for the effort, a little fee, and they'll tell you, what things are worth. You can value them to yourself just the same. You can also, if you go to Goodwill and you give something, a substantial amount of stuff, you may want to, you do want to ask them for a receipt and have them just scribble down some value, or you fill in a value. Typically, they just give you back a blank form. And that's where it's kind of helpful to maybe have, a picture or some details or something in the items you gave, especially if you're going to use that. So we're doing, whatever. Let's say 02. 02, and I think we're in the 2025 tax year for this particular form, so we'll see. Oh, so we're doing 2024. I never finished this one out. Same. But it's making sure that the day, the year you deducted it agrees with the tax return that you're trying to fill out, right? So household items, yeah. Again, if you want to get audited, put stuff in there. The IRS is going to go, yeah, right. Especially when you claim it's worth $1,500. And method determined, I'm going to go with, consignment shop value, comparable sales. Pick one. I'm donating to a thrift shop, so I'm saying it's going to bring them $1,500. Done with that donation. Boom. Purchase price, oh, that was like $8,000. Whatever. You can't be this careless when you're doing stuff. And how long have I had it? Oh, I'm just going to put various. Yeah. And how required. Purchased. Yep. More than a year. Yeah, whatever. That's my house. I didn't retain ownership. So anyway, that will theoretically change these numbers. What I need to do, though, is I'm not sure if I'm at the standard deduction or not. No, I think what happened was taking those deductions out, I'm now back into the realm where TurboTax is going, okay, without that house, without that mortgage interest, you're going to take the standard deductions, right? These itemized deductions no longer count. So before you perjure yourself and lie about a bunch of donations and stuff, it did make a difference in my tax because I've decreased my itemized deductions have decreased below the level of the standard deduction. So do what you want. It's not changing things anymore. So you're just kind of spinning your wheels unless you have a couple big items like the property and mortgage and other things that would push you above that higher limit. So it's a pretty good illustration of what I was talking about between standard deduction and the itemized deductions. So anyway, you can go through here. You can see that, bogus information, but I got good planning factors back. I could change my status from whatever, married, single. I can change my income. I can change all sorts of things, and it's going to give me a fairly, if I garbage in, garbage out, if I would have put in better data, it would have given me, better information. Again, TurboTax going to upsell you all this other stuff. No, I don't want any of this stuff. They're trying to whatever, and then the wages and the crypto and all kinds of stuff. It's just a better experience, in my mind, way better than doing the taxes on the forms. And it gives you a chance, even if you don't file with these guys, it gives you a chance to, ferret things out. Keep in mind too, and no slight towards this woman, but I had some really knucklehead friends back when I was in fighter squadrons, and these guys, I wouldn't trust them to do my taxes. And I think they worked for Jackson Hewitt. Anyway, it's one of these tax preparer things. They did that on the side. It's like, dude, you're not good at math. I know that. I've seen you. I've seen you try to add figures in your head, and you're doing people's taxes. My God. So anyway, these tax places that have to, hire a whole bunch of people quickly. If you're gonna hire somebody to do your taxes, yeah, maybe a CPA. A lot of times too, they'll say, "Oh, we're going to give you an instant refund." The IRS doesn't do instant refunds. What the tax people will do, if you're a little tax preparer, they'll basically give you a loan on your estimated refund. So you're taking a fairly high interest loan on your return that's now signed over to them. So there's a lot of weird financial stuff that goes on in that realm. So I think we got out of that what we needed to. Let's get back into this. Anyway, it's a useful tool. And, don't give them money unless you're actually filing with them. But in terms of the other stuff, using their service, yeah, it's an excellent tool to figure out different tax situations. Exemptions, yep. Deducted from gross income. So you'll see this when you go into taxes, how many exemptions you can claim. Taxable income, and then calculating taxes. So talked about progressive tax system, positive relationship between an individual's income and the tax rate. So the higher the income, the higher the rate. So not only, if it was, say, 10% across the board, obviously the person who makes more money would pay higher because that 10% would be more. But not only does a person pay more, but the rate goes up considerably. This was 2024. So tax brackets. I've got a video that I think you guys will find quite useful because I'll explain tax brackets to you right now. And it's not a science. It's really not that difficult, but it is the most misunderstood concept. And in fact, if you've got somebody who's giving you advice on taxes or helping you prepare your taxes, and they say, "Oh, you don't want to do that. You're going to be in a higher tax bracket," you should probably run because that person fundamentally does not understand the way tax brackets work. So I'll go through it to kind of give you an idea. Okay, so let's say somebody says, "Oh, I don't want to make more than 190,000 because if I make more than 191, 950, I'm going to be in this 32% tax bracket. I want to stay down here in the 24% tax bracket." Yeah, that person doesn't understand the system, and they're just and if they're giving you advice, they should not. I mean, that person is you're getting stupider as you go. So the way it works is this is the tax rate over here on the side, right? And we'll look at the single column. Granted, they're going to be less. Single is the worst case. Single people are viewed as the ones who can most afford to pay the taxes, and they don't have other people dependent upon them, and they certainly don't have any dependents. So if you get if you're head of household, for example, you can take it all the way up to 16.5. You're not knocking it out of the park by any stretch, and so you're going to stay in that 10% rate. And in fact, when you look at the charts and the deductions, you'll actually get some money back. But anyway, looking at this first column, single filer. So what this is showing you is that for your income, let's say you're making 50 grand. Your whole 50 grand is not taxed at 10%. No. Out of your $50,000 worth of income, the first tranche, that first chunk of your 50 grand, from the $0 up to 11,600, that chunk of your income is taxed at 10%. That next segment of your income from 11,600 to 47,000 is taxed at 12%. And I said you're making 50 grand, right? That chunk, that little sliver from 47,150 up to 50 grand, so that 2,800-ish, 2,850, is taxed at 22%. Only that sliver. They don't go back and tax all your income at 22%. Nope, just that last little bit. So let's say this, this idiot who says, "Oh, I don't want to make, 192,000 because that's going to push me into this other tax bracket." No. Your income, that last $50 that you made that took you up to 192,000, that from 191,950 to 192,000, that $50 in there is taxed at 32%. The rest of it is taxed in relation to the tax rate. So those are tax brackets. Now, the one thing that people may be confused, if I'm going to give them any credit or whatever, sometimes your overall income, you may not want to take a higher paying job in certain circumstances if it makes you ineligible for other programs. It's a societal ill. It's a disincentive to people to be productive and work. But I'm not going to pretend that there aren't situations where, if you're making 60 grand versus 50 grand, you're actually ending up with more money by making 50 grand because you qualify for maybe the Affordable Care Act, fully paid for. You're making 60 grand, you got to pay for your own medical insurance. So, there may be situations like that that will change. And that's a shame that there are programs out there that probably are even outside of the IRS that would encourage people to be less productive because they want to maintain their eligibility for basically programs that maintain their poverty. It's a sad situation, but it is what it is. So anyway, I think that's a nutshell of tax brackets. If you don't get it the first time, watch the video and you'll figure it out. But don't whatever. It's a good litmus test to figure out whether people know what they're talking about or not. Long-term capital gains rates. So when I said 15%, yeah, most of us are in this range of making more than 9 grand and less than 406. God bless you if you're up there. If you're one of these wealthy, whatever, you're going to pay another 5%. For long-term capital gains, when I say they're 15%, that applies to most of us. Unless you're, a 1%er on either end, you're going to be paying 15%. So this one, you can see, you get up there in the higher tranches. That's why I said 28, I think, on the thing. Whatever. These rates in here are roughly double what this one is. So you kick butt, you make some money on whatever, and did you hold it a year? If you can hold it a year, that's a good thing. But if it's super volatile, if it's like crypto and it's a bad time in the crypto season, yeah, I'd dump it in a heartbeat. Determine tax liability. So yeah, tax liability and how much you paid, and bada bing. So I talked about tax deductibility, and so you saw the taxes on items change for, like, let's look at that mortgage interest deduction or the property tax deduction. It's a deduction. It's not a credit. Credits and deductions are not the same at all, right? A deduction is good. A credit is wonderful. Okay, if I'm making, whatever, 100 grand, and I donate something for, say, $1,000 worth of stuff, I'm able to deduct my income from 100 grand down to $99,000, right? And that income up at $99,000, let's say that income up in that range is in, say, a 30% tax bracket. That means by donating $1,000, I don't have to pay taxes on that $1,000, right? So essentially, I'm getting I'd have to pay 30% on that typically, or $300. So by donating that $1,000, I'm actually saving $300 on my taxes. So it's deducted. It's deducted from my income. So it's a good thing, but not a great thing. I mean, it's a positive thing. A credit is a credit. A credit means you owe the government $15,000 in taxes. Oh, you got a credit for $1,000. You owe the government $14,000 on your taxes. It's a one-for-one relationship. So, yeah, child tax credit is a big one. If you're doing good things like with adopting a child, and a bunch of legal expenses, that's viewed as a societal good, which is obviously it is. And so, those legal expenses may be a deductible, or they may actually be a credit. Sometimes there's renewable energy credits or whatever. These change from year to year. EV credits sometimes. If they judge something's a politically favorable program, and for the most part they are, there'll be a credit. So when somebody says give to this thing, oh, it's tax deductible, that's nice and that's good. But if they say, oh, there's a tax credit, that's great. So know that relationship. College expenses, tax credit, right? 529. Yep, that's a way to. Let's say you're doing your term paper. We're out some months now, and you're doing your term paper, and as part of your plan, you say, I'm going to set aside a fund to pay for my children's tuition, and I'm going to put it in a mutual fund, and bada bing, I'm going to end up with $100,000 in that account. That's good, and you'll get a B or so on that paper. If you said I put it in a 529 plan or one of these other type plans that are designated by the IRS, that's great, and you'll get an A on the paper. The difference being that the fact that you just put it in a fund and kind of earmarked it for your child and said, yeah, I'm going to put this $100,000 aside for my children's education, means that when that child goes to withdraw it, or you withdraw it out of your account to give it to your child, you're going to have to pay tax on it, even though it's used for educational expenses. If you would have been smart about it, you would have put it in a 529 plan or one of these other type plans, and because it's used for educational purposes, it is all goes to your child. There are no taxes charged on it. So that's cool. And if your little Johnny doesn't end up being the future engineer and ends up in whatever, takes another line of work, or becomes a whatever, staying in one of the, if he's incarcerated, well, you can still get the money out of that account, but yeah, you're going to have to pay taxes on it, maybe a penalty, but that's on you. That's on your parenting skills, but yeah. Yeah, so like I say, if you put that $100,000 in a 529 plan, you put $100,000 in there, the child gets $100,000. You put it in a regular plan, yeah, your child gets maybe about $80,000 because you had to pay taxes on it. Earned income. So this is where some of these very low income things end up being a positive, where you end up getting money back. You get credit for your children, and you're making whatever, you get $1,000 a child and you didn't actually owe anything on your taxes. They don't just call it a wash, they actually give you money back. So fair enough. I mean, we do need more children. Beat TurboTax to death, I think. Homework. Okay, and so these are the problems. The homework, what I'm going to do, and it's all part of the plan. You hand in all your homework as a batch assignment, and but because of the different versions of the textbooks, there are different page numbers and all that stuff associated with it. So this week, I guess I'll probably put out the basically assignment sheet that has kind of the intro to each questions, and then you can kind of match it up, and you can figure out where they call it a problem or question or whatever, what the page numbers are. It should just make things easier. And that will be on Blackboard. And that will also be the place where you actually submit the homework. And so, you do the homework however you want. Some people do it by hand and submit JPEGs. Other people put it in a fancy PDF. Some people put it in Word. Sometimes I have problems with some of like the Pages, the Apple generated product. You can put it in a PDF if you're going to go that way. That'll make my life easier. But it doesn't matter. However you turn it in, you turn it in as a batch assignment, and you turn it in just prior to the midterm. So you don't start on the midterm until you've turned in the homework. And then there'll be a second batch of homework, and I'll be turned in just prior to the final. But I'll put out that consolidated kind of assignment thing with all the homework assignments on it going from now until the midterm, and that should make your life a bit easier. Good luck.